Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Utz Brands Inc. Annual Report. Utz Brands Inc. offers a diverse range of businesses and services that cater to the snack food industry. The company's primary business involves manufacturing branded salty snacks, including potato chips, tortilla chips, pretzels, cheese snacks, pub and party mixes, pork skins, and ready-to-eat popcorn. In addition to its branded products, Utz Brands also provides non-branded and non-salty snacks through partner brands, private label, and co-manufacturing products. These services include salsa and dips, as well as other snack options that cater to various consumer preferences. The company operates under multiple brand names, including Utz on the Border, Zapp's, Boulder Canyon, Golden Flake, Miguelitos, Hawaiian, Bachman, Tim's Cascade, Dirty Potato Chips, TGI Fridays, and Vintners. Its distribution channels are diverse, encompassing direct-to-warehouse, direct store delivery, third-party distributors, and direct-to-consumer sales. Overall, Utz Brands' business model is built on providing a wide range of snack food products to consumers through various channels, making it a significant player in the industry. The decline in Utz Brands, Inc. (UTZ) stock price over the past year can be attributed to several key events that have eroded investor confidence. The company's second quarter 2025 financial results were a major contributor to this decline, as it reported a significant decrease in net income and adjusted earnings per share (EPS). This was followed by analyst downgrades and price target reductions from prominent firms such as TD Cowen, Piper Sandler, Bank of America, and UBS. These negative revisions reflected concerns about the company's profitability and future growth prospects. The fourth quarter and full year 2025 financial results further exacerbated these concerns, as Utz Brands' revenue fell short of analysts' projections, and its EPS guidance for fiscal year 2026 was lower than expected. This combination of disappointing financial results and reduced analyst expectations has led to a substantial decline in the company's stock price, with shares dropping over 27% in the past year. The stock reached a new 52-week low of $9.02 on February 12, 2026, significantly below its 52-week high of $14.67. Utz Brands, Inc. maintains a market capitalization of $1 billion, broadly in line with the industry peer group. Utz Brands, Inc. trades at a higher price-to-earnings ratio of 935 times, and a lower price-to-book ratio of 1.13 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The leverage on the balance sheet appears elevated, with liabilities of 52% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 2.67%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for the company are multifaceted. On the growth side, product innovation has been a significant contributor, with new flavors and subcategories leading to substantial increases in revenue. The acquisition of Insignia International's DSD distribution assets and expansion into the California market have also driven growth. Conversely, revenue decline is attributed to several factors, including the sale of Good Health and RW Garcia Brands, closure of a manufacturing facility, lower net price realization due to promotional activities, and IO conversions. The company's revenue growth or decline is influenced by various factors beyond these primary drivers. Trade promotions, distribution route purchase and sale transactions, goodwill impairment, and employee stock purchase plan grants also have an impact on the company's revenue. These factors highlight the complexity of the company's financial performance and the need for a comprehensive understanding of its revenue dynamics. The net income of the company underwent significant fluctuations between 2023 and 2025. Initially, it decreased from $30.7 million to minus $7.7 million in 2025, indicating a substantial decline. However, when comparing the figures for 2023 and 2025, there was an increase from minus $24.9 million to $0.8 million, showing some improvement. The net income also saw a decrease of $125.6 million between 2024 and 2025. The profit margins of the company experienced changes in both gross and operating profit margins. The gross profit margin decreased by 1.3 percentage points from 26.2% to 24.9%, while the operating profit margin increased from minus 0.2% to 1.4%. These changes were largely driven by factors such as increased expenses, higher marketing spending, discontinuation of unprofitable product lines, and reduced sales expectations. The key drivers behind these changes include a failure to adapt to the changing retail landscape, inability to innovate or market products effectively, consolidation in the retail industry, shifts in consumer trends and preferences, and increased competition from hard discounters and specialty brands. These factors collectively contributed to the fluctuations in net income and profit margins between 2023 and 2025. The company's financial performance indicates a strong ability to generate cash flow from its operations. One key factor contributing to this positive trend is the sale of receivables, which serves as a source of cash for the business. Furthermore, the operating cash flow status is listed as positive, signifying that the company is successfully managing its cash inflows and outflows. In addition to these indicators, the company's lease agreements have also been generating significant positive cash flows in recent years. Specifically, the data shows that the company has experienced positive operating cash flows from leases in all 3 years examined: 2025, $27.5 million, 2024, $20 million, 2023, $16.7 million. This consistent performance suggests a stable and reliable source of revenue for the business. Overall, these factors collectively demonstrate that the company is generating positive operating cash flow, which is a crucial indicator of its financial health and stability. The company's debt level and interest expenses have undergone significant changes over the past year. While there are some inconsistencies in the data provided across different pages, a clear trend emerges when considering the most consistent summaries. In terms of debt level, the numbers indicate that it has increased slightly from $768.6 million to $849.6 million between December 29, 2024, and December 28, 2025. This increase is evident despite some fluctuations in variable rate indebtedness and total liabilities. However, the overall trend suggests a moderate rise in debt. On the other hand, interest expenses have decreased significantly over the same period. The data shows that interest expense has dropped from $44.9 million to $43.1 million between 2024 and 2025. Furthermore, interest rate swaps have also seen a substantial decrease, plummeting from $25 million to just $1.1 million. Overall, these changes suggest that the company is managing its debt levels effectively while reducing its interest expenses. This trend is likely to be beneficial for the company's financial health in the long run. Management is optimistic about the company's future prospects, citing opportunities for long-term growth in the salty snack industry. The key drivers of this growth include expanding into new customers and underpenetrated channels, executing productivity efforts, making infrastructure improvements, and strategic acquisitions. To achieve these goals, management plans to accelerate investments in marketing and innovation to drive top-line growth. This will involve penetrating expansion geographies and untapped channels and customers with branded salty snacks, as well as benefiting from consumer trends, driving consistent retail sales for salty snacks. In addition to investing in growth initiatives, management is also focused on managing costs and maintaining a strong cash position. This includes removing food, drug, and cosmetic colors from the portfolio by 2027, offsetting rising costs through manufacturing and distribution efficiencies, price increases, and hedging strategies. Overall, management's strategy is centered around long-term growth through investments in marketing and innovation, geographic expansion, and productivity savings, while also managing costs and maintaining a strong cash position. The company has made several strategic acquisitions and divestitures to expand its business and optimize operations. In terms of acquisitions, the company has expanded its geographic footprint through a series of purchases, acquired distribution routes, and entered into business combinations with Collier Creek Holdings and UBH in 2020. Additionally, it acquired regional brands and distribution capabilities in core geographies, as well as purchased facilities from other companies. The company also made significant divestitures to streamline operations and focus on key areas. It sold its Good Health and R.W. Garcia business for a gain of $44 million, closed manufacturing facilities in Grand Rapids, Michigan, Bluffton, Indiana, and Birmingham, Alabama, and recognized a gain of $23.1 million from the sale of these assets. These transactions demonstrate the company's commitment to strategic growth and optimization. The company has a history of paying dividends to its shareholders. According to the provided summary, dividend declarations for 2023, 2024, and 2025 were $18.5 million, $22.6 million, and $22.7 million respectively. The actual dividend payments also reflect this trend, with payments of -$22.3 million in 2025, -$21.7 million in 2024, and -$18.5 million in 2023. The company's commitment to paying dividends is further emphasized by the mention of accrued dividends and distributions as of December 28, 2025, $9 million, and as of December 29, 2024, $8.6 million. This suggests that the company has a consistent track record of providing returns to its shareholders through dividend payments. It's worth noting that there is no information available on share buybacks by the company, indicating that it has focused primarily on paying dividends to its shareholders. There are concerns about inventory buildup or supply chain disruption mentioned in several pages of the extracted summaries. On page 4, it is noted that effects of inflation, tariffs, or supply chain disruptions could negatively impact operating results. Similarly, on page 5, it is stated that disruption to manufacturing operations, supply chains, or distribution channels could impair production and delivery of finished products. Furthermore, pages 6, 22, and 30 mention the potential for pandemics, epidemics, or other disease outbreaks to disrupt consumption patterns, supply chains, and production processes. Additionally, page 23 highlights the risk of shortages of raw materials, energy, water, and other supplies affecting business operations. Pages 43 and 45 also emphasize concerns about supply chain disruption due to various factors such as weather impacts from climate change, commodity market conditions, inflationary conditions, and rising costs related to fuel and freight rates. The company has even invested in initiatives and structural changes related to supply chain transformation, indicating a recognition of the potential risks. However, it is worth noting that on page 50, there are no concerns about supply chain disruption mentioned, but inventory buildup is acknowledged as a concern. Overall, while there are some pages that mention no concerns about inventory buildup or supply chain disruption, the majority of the summaries highlight potential risks and disruptions in these areas. That concludes the financial summary for Utz Brands Inc. Feel free to comment below, and I will be happy to answer them when possible.